Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, September 29th, 2021. And our top stories today: alternative investing integrates with traditional asset management. And could we see alternative investing in defined contribution retirement plans? Joining me now to discuss this and a lot more is Randy Plavica, a journalist with Fund Intelligence. Randy, always great to talk with you. Thanks so much for joining us on the program this morning.
Thanks so much for having me, Jeff. Always a pleasure. And I'm back in the office now, at least on a hybrid basis. So reporting in from our wonderful lounge here.
And Randy, I see you in a shirt and tie, but I have to ask, are you wearing a pair of shorts?
I've managed to put on a pair of pants today, which is a surprising feat considering it wasn't so long ago I was in the remote office as opposed to the actual office.
Okay, well, thanks for answering such a personal question. Randy, let's talk about traditional asset managers. So our Fidelities, our BlackRocks, moving into the alternative investment space. You've been covering this for Fund Intelligence. What can you tell us here?
Yeah, so right now there's been a pretty big interest from both asset managers, large and small, to get into basically non-traditional paths of investing. Typically, this manifests in private alternatives, whether that's private equity, private credit, private real estate, pretty much any asset class you want to throw a private atop. That's what they're looking into right now. We've seen a lot of movement, I would say, especially in the boutique space, in terms of managers with 10 billion to 100 billion in assets under management that are really trying to carve out more of a name for themselves by adding this sort of stuff. One manager I'll highlight, and by no means are they the only person doing this, but Victory Capital especially has been building a really nice pipeline of alternative capabilities, both through acquisitions and also investments, both in the US and beyond. What that allows them to do, right, is basically enhance their mutual fund and their ETF offerings, whether they're serving institutional or retail clients, basically give them a better product. On the higher end of the market, you also have the traditional, like you said, the BlackRock Fidelities doing the same thing. So I think everybody's on the hunt for it. I'll go ahead and pass back to you. Sorry about that.
No, it's okay. I didn't want to interrupt you and your flow. You were hitting it so well. Randy, is the interest there trying to find asset or investments for retail and institutional, or is this a institutional play? For example, endowments, foundations, pension plans, both public and private. I mean, what's the genesis here? Is it to create more entrees, or where do you think that demand is coming from?
I think it initially started from institutional for sure. And I think now it's actually basically trickling down into the retail space too. What it boils down to, right, is diversification of portfolio, right? Having more exposure to more things, basically making sure that when we're in a down market or if we're in a weird cycle of the market, we have protection against the worst throes of volatility. Obviously, when the pandemic first hit back in March 2020 and really shocked markets, I think everybody realized we really do need a barrier of some type. And private equity was doing decently well last year, if I recall. And obviously, I don't have any numbers on file for that. But there was a lot of managers that were looking toward it as kind of like a stopgap in between, a total free fall of performance in their mutual funds and ETFs. And really, private alternatives were starting as a way to kind of bolster the lineup. We've also seen one-of-one offerings, right, where they go into basically the private alternative space and they will launch a very specific fund, whether it's a closed-end fund or a traditional fund, and bring those sorts of elements in. But in terms of so far, the most of the integration I will say has been surface level. They're adding 5%, 10%, 15%. It's meaningful, but it's not dominating the portfolio, whether that's on the fund side or not. To your point, it does help the institutions a lot. A lot of them have been used to this, right? With the pension plans and DB plans, they've been able to get a lot of this exposure already. But as we know, defined contribution is very much in favor, and bringing that back in has been more of a focus too. Obviously, a lot of institutions still have customized options. They're still able to get access. On the retail side, the flip side of that coin, I suppose, at this point, they're just trying to figure out how do we offer a flavor of this to retail investors, whether it's in an ETF, whether it's in maybe a closed offering that there's some type of limited access to for clients, or potentially, through another type of plan. DC plans obviously being one avenue that it's being pursued. And I'm sure we'll talk about that a bit more. But in terms of overall right now, exposure and kind of offering to the public, it's pretty much institutional focused with a lens of, retail is going to become more prominent, whether it's in a few quarters or a few years, but people want it because people want better returns. And at the end of the day, you have to give it to them. You have to figure out how to make very complex investing environments very simple for these types of people, not because it isn't, something they can understand, but really because at the end of the day, not everybody is a registered investment advisor, right? We don't have all that same expertise and capabilities.
Yep, and you make a really interesting point. And so, these types of investments typically for large pools of assets. I covered them earlier in the segment, and people want return. And getting a return from a traditional 60-40, that's 60% equities, 40% fixed income, generally is not going to do it. You've seen the public plans and pension plans move away and allocate to things like alternative investments. But Randy, that comes with a little bit of risk. And I know the SEC, not a little bit, a lot of risk. There's a lot of risk because there's downside. And also you got to know, to your point, you got to know what you're investing in. I mean, like, I wouldn't understand exactly what a hedge fund is doing. I'd have to really understand, ask questions. And most investors need to be in that position to do that.
Yeah, I agree. Demystifying is a huge portion of it too, right? Because, I'm not knowledgeable on everything that's happening in the private equity space. And to some extent, not every manager is either. It takes a lot of knowledge base to be built. So when you're adding these capabilities, they really need to have thought leaders or somebody in that area with expertise. A lot of times why we're seeing now, and this happens both ways, where hedge fund managers join an asset manager and kind of work as a head of some type of division, and vice versa, where asset managers going to the hedge fund world where they may have not traditionally lived. And there's a lot more parlay back and forth, I think, now than there was before. A lot more fluidity in terms of people going from a traditional shop, like BlackRock, and heading off and starting their own hedge fund, and vice versa, right? So it all kind of feeds back into itself. I think ultimately it'll be fruitful. It'll be beneficial if it can be figured out appropriately. But to your point, right, it does come with a bit of caution, a bit of risk. And the SEC is always going to be mindful of stuff like that as it impacts the investing environment. Absolutely.
You got to make sure you have a good market, but also you're regulating the market. That's really the role and responsibility of the SEC. Randy, I want to take a quick break. When we come back, we'll talk about integrating alternative investments in defined contribution plans. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking to Randy Plovica of Fund Intelligence. Randy, thanks as always for staying with us this morning.
Of course, Jeff. Glad to be back.
Yeah, it's good to have you from I liked your apartment, but it's good to have you from the office location as well. I'm sure your colleagues although they're probably very socially distant right now. I'm sure they're happy to see your bright, smiling face. Randy, let's talk about the defined contribution retirement market. DC assets, if my recollection is correct, over $20 trillion. You got the federal thrift, you got 401k, 403b, 457, very attractive market, but really there's not a lot of alternative investing in these plans, but that could change.
Yeah, most definitely. I think right now is a really interesting point too. As we've seen alternatives kind of creep more into the traditional asset management space, a lot more retirement focused managers have been starting to take a look at it as to how can we get this in here. One manager I'll highlight, and by no means is this the only manager doing it, as I've said before, but AllianceBernstein is a really interesting case in that they have a really good lineup of target date funds, but they've also been really focused on building their alternative capabilities in recent years. Most recently, they've been doing a little bit of investments over there, building it up. As you may know, they are backed by Equitable, which is a very large one-time insurance company owned by a UK parent. But at this point in time, it's like Equitable and AllianceBernstein are really trying to build out alternative capabilities for AB. What this means, at least on the target date side for them, right? They might be able to bring in an approach wherein they're basically investing a sleeve of the target date fund in private alternatives. By no means is it seamless under the current SEC regulations and guidelines, but there is ways to achieve that exposure. We've actually already seen it kind of done. There's this one firm called Mission Square Retirement, formerly known as ICMARC. Their asset management arm, Vantage Point, has been doing a really good job, I would say, of bringing this in. And they were planning on basically incorporating private alts over time. So I've spoken with Wayne Wicker over there, a wonderful CIO, and he's basically informed me in prior conversations, not as of late, but they're basically looking to achieve a very slight exposure for private alternatives over time. And that includes, I believe, private equity, private credit. Obviously, there's a little more color there in terms of like what they're looking to get into, but they're trying to figure out a way to do it that is both making sense for the participants, making sense for the advisors, and then ultimately opening up the DC world to a bit of the private alternative world that there wasn't access to before.
Yeah, and there's this balancing act. One is you want to be able to provide investments that are non-traditional to participants, employees in a retirement plan that they would not ordinarily have access to. That's number one. Number two, you need a good regulatory framework in order to allow fiduciaries to do this, right? So you don't want to be on the hook as an employer if you're a fiduciary and benefits in this plan. You don't want to be sued if you offer said investment. And three, you've got to make sure that you are looking out in terms of fees, because as we all know, many of us have lived through the Department of Labor fee regs and are still doing so, by the way. Fees matter, and it's that compounding of fees that can really have a deleterious effect on participant balances.
Yeah, you're absolutely right. I think one interesting avenue I've seen taken too is more incorporation of real estate, which I know is not that controversial or private alternative class, but bringing that in. There's a couple asset managers already out there that are already basically very well entrenched in the real estate space atop their traditional mutual fund and ETF offerings. And they're starting to basically look at how we integrate that into the retirement picture. I think what's really interesting, right, is that similar to your point, everybody's looking at fees. How do we keep it cheap? How do we keep it affordable? Does this mean we go all passive, even though our expertise is inactive? Figuring out kind of the blended approach, I think, is really interesting from my perspective, too, because it doesn't seem like there's going to be one route to get there. It's very similar to the retirement income conversation. I think everybody's trying to figure out, I guess, one part of the puzzle to make it all happen. But by no means is there going to be a roadmap or a blueprint to getting there. I think most notably right now, it's very much available, or private alternative exposure is very much available through custom offerings, right? When you're designing one-of-one portfolios for whether it's a big client or a retail client with a lot of money to flex, it's very possible to already add this type of exposure. The basically where it gets a little bit, I guess, fuzzy, right, is the risk. Because at the same time, there's always the fiduciary liability that a lot of advisors are balancing. You never want to be in that sort of trouble, right, where you're basically putting your own practice at risk just for the sake of achieving some slight exposure to private alternatives. Again, if the clients really want it and the clients have expressed that, of course, you have to kind of fulfill that. But it's a balancing beam. People have to walk that and make sure that you're doing it right, and not just taking a leap of faith and hoping that your private equity investments pan out for your retirement portfolio.
Yeah, and Randy, you mentioned traditional asset managers. You mentioned some record keepers in Mission Square Retirement and others. But let's not forget the consultant community. Those are retirement plan advisors, many of whom now have managed account products. And you and I have talked about managed accounts. It seems like since we first met, we've been talking about the growth of managed accounts. Are you seeing big consulting firms, maybe consider this as an allocation within their managed account solution as well? Because you mentioned target dates, the natural corollary to that, managed accounts.
I think there's been an uptick in it. I don't know if the actual like assets flowing there have increased whatsoever, but I think in terms of interest and conversations happening, that's definitely generated more interest. And I would say maybe more demand for education. A lot of times, as we both know, innovation in terms of like portfolio design takes a couple years to come to fruition. So although you and I have been talking about managed accounts for a long time, and private alternative exposure has been just as prominent a feature in those conversations, I think like basically seeing widespread adoption hasn't quite happened yet. I don't expect it to be an avalanche, right? I very much expect it to be like a slow build over time, if it ever happens. But I think over time there will be more demand for it, right? Because people at the end of the day want a really well-balanced portfolio that can survive anything the market throws at it. And clients at the end of the day want what's best in the market. Oftentimes cost is one of the only factors there. But if they can get the best with only a little bit of risk or a little bit more added risk, they're happy to, bite a few basis points worth of cost just to make it happen. I think all that being said, I think the environment's still very fruitful. I'm hoping to see some more development. Oh, good. Sorry. Go ahead.
No, go ahead. Go ahead. Finish your thought. I jumped on you.
No worries. I'm hoping to see some more development by the end of this year. I'm continuing to have a lot of conversations with asset managers in the DC space and the traditional space that are working on stuff like this. It's very much tied to the retirement income conversation too, which is kind of, I won't say odd, but to me interesting, right? Because at the same time, they're trying to solve the very complex needs of retirement income. They're trying to solve for basically bringing private alternatives into the DC picture. It's by all means, it's, a very similar conversation, but it's always interesting to me that, all these plates they're seemingly balancing at once. I'll go ahead and toss back to you. Apologies for that.
Yeah, no. Thank you very much. I mean, you're the expert here and you're covering this. You've got your boots on the ground, so to speak. I love that you brought the retirement income piece. And I guess my last question for this segment is, where do alternative strategies fit in with insurance and insurance type products? Because we've seen when managing a general account, an insurer oftentimes will allocate money to alternative investments. And that just for everyone's knowledge, that general account is what backs all the guarantees. So it makes sense to me that insurance companies and the products that they're offering would consider alternative investments within variable annuities, and fixed income annuities and other types of vehicles.
Yeah, I think annuity integration is probably top of mind. I wouldn't say in terms of like their actual general account portfolio, when they're building that, they're thinking, oh, we've got to put X% toward private alternatives, otherwise it's not going to be a great offering. I think any amount, of exposure can make a great offering, right? At the end of the day, as long as your equity and your fixed income are well balanced and well exposed on a national or global basis, looking from the lens of a US portfolio, you're going to do well. In terms of like annuity integration, though, I do very much see those conversations happening on the variable annuity side. There's very slight noise around it with the registered index linked annuity space. Obviously more so with the variable though, because that's kind of where you can have a little bit more fun, if you will, with design, where you can have, slight more risk. But at the same time, when you're selling these to clients that are looking for annuities, you can be ultra transparent with what's in the offering. And that's what it's going to boil down to, right? Is I think with insurance companies, especially, it comes down to how transparent they want to be with the offerings. Clients will always value transparency over a lot of other things. And I think bringing private alternatives in can sometimes muddle that or make it a little bit more opaque. And just, I guess, maybe sort of tempering that is what it's going to look like, right? I haven't seen any annuity providers yet roll out and say that, private alternatives are the future of their product development plans for the next some odd years, but they're all working on it. I think at this point, everyone that I've spoken to, at least in recent, has been trying to figure out, and it usually, like to our point previously, is happening alongside that retirement income discussion of how do we make something long lasting that will survive different market cycles, and private alternatives present a route to surviving some of the worst throws in the market.
Well, Randy, the financial services industry, the retirement industry, certainly not fast moving by any stretch of the imagination. And in fact, we've been talking about a lot of these issues for a long time. We're going to have to leave it there. And by the way, Randy, I think your theme song, we'll have to get the license to this, is ZZ Top's Sharp Dressed Man. Randy Plovica, always great to see you. Thanks so much for joining us. And we look forward to having you back on the program again very soon.
Thanks so much, Jeff.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited? And do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.